Hi, this is Professor Lewis. Hey, I'm so excited I get a chance to introduce to you the international taxation chapter that we're going to be reviewing. I hope you're viewing this prior to actually reading the chapter because I want to give you a chance to better understand what you're going to come across. First of all, why are we doing international tax at the junior core? Well, a couple years ago, Ernst & Young, EY, gave the school a grant with the intent to help us as faculty be motivated in ways to introduce the students of BYU to a global mindset. What does that mean? Well, a global mindset really means the recognition that the world in which you live, the way we operate now, is so global. At the moment, right now, for instance, I'm making this recording in Mexico. It's so easy for us to jump in and out of a global setting. And so at this point in your career, it's important that you have a better sense of how tax works in an international setting. So what is international tax? And I can hear some of you saying, dude, we're barely struggling with domestic. Why are we doing international? Well, you're not doing international tax. No one's asking you to file a UK return or do a Canadian return. What we're doing instead is we're talking about, given that taxes are paid in foreign jurisdictions, what's that impact on a U.S. citizen or a U.S. company? Now, that particular type of taxation is called outbound taxation. Outbound meaning that it's a U.S. citizen or resident or a corporation, U.S. corporation doing business outside of the U.S. Now, what's inbound taxation? Inbound taxation is a foreign corporation, for instance, coming into the United States and doing business within the United States. And as you read, you're going to discover really quickly that the tax consequences for both are a little different. Now, there are two types of situations you're going to find yourself in when you're dealing with a U.S. Corporation, let's just call it, and a foreign jurisdiction. Either that foreign jurisdiction and the United States have a tax treaty or they don't. Now, a tax treaty is just an agreement you have between two jurisdictions that will help you appreciate and understand the way you're going to behave when commerce is being done. Those tax treaties are usually very favorable for the countries that are entering into them. Now, why are they favorable? Because you can usually get lower rates, lower withholdings, more definitive path. But you know what? The majority of the countries in the world, the United States does not have a tax treaty with. So you'll learn a little bit more about how the tax treaties work and why they're so important. Now, who does the United States tax? You know, how does the United States look at international tax? Well, you philosophically should understand one thing, and that is several years ago, right around when the country was formed, the U.S. border went out about 3 miles off the coast of the coastline. Why was it only 3 miles? Why didn't they assert 10 miles or 20 miles? Because the answer is that's about as far as a cannon would fire. The reality is the United States will tax if they can, just like every other jurisdiction. So the whole concept, this nexus that you're going to read about, the ability to tax somebody, is really what drives this. If the United States has the ability to tax, they will. So who do they tax? Well, any citizen or resident of the United States is taxed, and on the worldwide income. Now, in the book you're going to read, the term is used called residence-based, or we sometimes call it worldwide taxation, and it's opposed to a source-based, meaning or territorial. Most of the world is territorial, which basically means in Canada, for instance, Canada is only going to tax the activity that takes place within Canada. And if you're a Canadian corporation, you do business in the United States, Canada's not going to worry about it. Whatever you pay the United States in tax, you pay, and that's the end of it. But instead, the United States says, I don't care where you are, you're going to pay tax wherever the earnings are, and the United States is going to tax all of it. Now, you might be saying to yourself, that seems patently unfair. And the reason is because you think, wow, you're going to get overcharged. You're going to pay tax twice. Well, it doesn't quite work that way. And the reason why is because the United States also offers a tax credit. And what it basically amounts to is if you pay tax in a jurisdiction, say the UK, and you pay at 18%, which is about the rate in the UK today, when that money, when those profits are brought back to the United States, then the United States will tax them. And when the United States taxes them, they'll tax you at the U.S. rate, but they will give you credit for the taxes you've already paid in the UK. So it's a credit system. So the United States has a foreign tax credit. And you know what? A lot of what we're going to be doing here in these next 2 days are dealing with the foreign tax credit. How is it calculated? In order to do that, you have to do a couple things. One, you have to know what the taxes paid were to the foreign jurisdiction. Good news here, folks. That's going to be given for you. We're not going to make you go through and learn another tax system. How Japan decides the taxes, Japan's issue. But we will tell you in US dollars, here's the amount of tax that this company paid. Now, what isn't given to you and what really we're going to spend a lot of time on is figuring out what is foreign sourced income. When the United States corporation does business with a foreign jurisdiction, how much of that income is foreign based? And the reason why that's important is because the amount of this credit you can take in theory is you can't take more of a credit in the US than the US would have taxed you had they taxed you direct. In other words, if the effective rate for Japan is say 40% and the effective rate for the US is 35%, the US is only going to give you credit for 35%. The extra 5% essentially is just lost. So how that credit's calculated, we're going to have to work on together as a group, and that's what we're going to get into. So a couple of other points, and then I'll turn you loose on your reading. First point, when is this income taxed? That's the very part, the last objective for day 2, and that's going to be critical for you to understand. In general, if the United States says we don't want to disadvantage a U.S. company, if you're overseas doing business and you're being taxed in a lower jurisdiction, we'll let you continue to have that benefit until you bring that money back to the U.S. in the form of a dividend, or you do a few other things. But you know what? If that corporation doesn't look or feel like a real corporation, if it looks like all you're doing is papering something through the Caymans, so you sell to the Caymans and the Caymans sells into Germany, that doesn't feel like you should really get a deferral. You're just trying to trap income in a low jurisdiction. We're not going to give you a deferral. And you'll see the term subpart F. It has to do with the Internal Revenue Code. Don't worry too much about the vernacular, so much as just the concept that we're going to learn a couple of situations where, you know what, it doesn't look as legitimate as it might seem. And so the U.S. says, even though you're in this jurisdiction in the foreign land, we're going to tax you currently. We won't give you a deferral. And then finally, the other thing to point out is we're going to learn a little bit about structuring, about how somebody might be able to structure their affairs in a way to take advantage of the fact the U.S. allows this deferral, not accelerate the earnings too quickly, and actually get really cool answers for your GAAP financial statements. So right there, I've said too much. Totally exciting, totally a fun time for you lies ahead the next couple days. So grateful for E&Y for encouraging us to do this, to put this program in place, particularly the junior core level. I think it'll give you a better appreciation of accounting, international tax, and tax in general, but more importantly, it'll give you a better sense of the global mindset and the global world in which you live. So with that, good luck. We look forward to instructing you in class and answering your questions that you might have. But until then, go ahead and get started, and we'll talk to you soon. Thanks.